Millions of Americans are denied the opportunity to build wealth for a simple reason. Their entire financial identity, their work history, and their earning potential are reduced to a single three-digit number. In the modern mortgage industry, the magic floor is 620. For a conventional home loan, anything below that threshold is treated as an immediate liability. But a 600 credit score rarely means complete financial ruin. Often, it is the result of high credit card utilization or an isolated event like a lingering medical debt that dragged the average down. Yet that specific number traps buyers in a specialized lending subtier. Standard banking rules go out the window, and completely different borrowing mechanics take over. When you apply for a mortgage today, a human being usually isn't making the initial call. Between 70 and 80% of all applications are judged entirely by automated underwriting systems, or AUS, in a matter of minutes. This flowchart illustrates a borrower's file entering the automated filter's binary logic. Dropping below a 620 FICO instantly routes you to a denied status. While lenders often pass this definitive no to buyers, federal guidelines grant the right to request a manual underwriting bypass. While banks rely on algorithms for speed and efficiency, the ultimate authority to evaluate risk and grant a loan still rests with human judgment. A manual review is a mandatory federal requirement for FHA loans when a borrower's score sits between 500 and 619. This human review pathway is also the primary mechanism for non-qualified mortgages. These non-QM loans serve self-employed gig workers and business owners who rely on bank statements rather than traditional tax returns to prove their income. Bypassing the algorithm is a specialized federal standard designed to measure the nuance of real-world finances that an automated system simply cannot read. This diagram shows how underwriters use compensating factors. These are specific, documented financial strengths that mathematically cancel out the statistical risk of a low credit score. The first major factor is cash reserves. Having 3 to 6 months of mortgage payments sitting in the bank after closing provides a massive safety net, proving you can weather a temporary loss of income. Next is minimal payment shock. If the new payment is no more than $100 or 5% higher than what you already pay, it shows you can handle the monthly burden. Finally, there is alternative credit. When a traditional credit profile is thin, underwriters will verify 12 to 24 months of on-time utility and cell phone bills to prove a consistent pattern of financial responsibility. Human underwriters use these concrete examples of real-world financial discipline to outweigh the automated mathematical risk of a 600 score. Navigating the sub-620 tier is dangerous territory. Because traditional banks often turn these borrowers away, predatory lenders specifically target this demographic, knowing they have fewer options. There are 3 explicit red flags to watch for. First, lenders charging more than 3% of the total loan amount in upfront fees. Second, loans carrying prepayment penalties that punish you for paying the debt off early. And third, lenders offering guaranteed approval without actually verifying your creditworthiness. Entering the housing market at a 600 score requires extreme vigilance. In real estate, desperation is the most expensive emotion you can have. Securing an approval with a 600 score comes with a mandatory premium known as the credit tax. Lenders apply loan-level price adjustments, which typically hit the buyer with an interest rate 1 to 1.5% higher than prime borrowers receive. This chart illustrates the core strategic dilemma. Should a buyer pay the higher subprime interest rate on the left or wait 12 to 18 months to repair their credit? The math usually points in one direction. Delaying a purchase for a year often means missing out on tens of thousands of dollars in home appreciation and lost equity. That massive financial loss on the right mathematically dwarfs the cost of the higher interest rate. To offset the sting of higher rates today, buyers can aggressively negotiate for seller concessions. On FHA loans, a seller can contribute up to 6% of the purchase price toward closing costs, preserving the buyer's liquid cash. A 600 score mortgage is a tactical entry fee required to access the equity market and begin building wealth. Before accepting those high rates, borrowers can utilize rapid rescoring. Lenders can submit proof of paid down debt or corrected errors directly to credit bureaus, potentially jumping a score from 600 to 640 in 3 to 5 business days. If rescoring isn't enough, the long-term playbook is straightforward. Secure the property, make 12 months of flawless, on-time mortgage payments to build credit history, and then refinance out of the high-rate sub-tier loan. A 600 credit score is not a permanent financial identity. The manual underwriting loophole gets you the house today, but your continued discipline secures the prime rate tomorrow.